Starbucks or Pret a Manger. You have a criteria, you want to be on these locations, on these high streets, at these rents, and your business model works. That is not the way our business works. And then when we closed the Holiday Inn transaction, I don't know, we were probably, if not the biggest, one of the largest hotel owners in the country.
And you hadn't hit 30 years old yet?
Yeah, I think I was 27. The business we're in is one that part of the strategy is that you have to wait for opportunities present themselves to you, that the market will tell you where those opportunities are. I said, I don't understand real estate. My dad said, well, there's only one rule. The rule is don't go broke.
Ryan, welcome to the People Property Place podcast.
Thanks for having me.
Not at all. Well, look, you come from a real estate powerhouse of a family that's built an amazing business over in Canada, and you've led the charge with Realstar, an uncle over here in the UK. What was it like growing up in that environment?
Well, I mean, I think I grew up in Toronto, and Canada, generally speaking, even today, is a pretty welcoming place to new immigrants. My dad was an immigrant to the country. His parents fled Europe after the Second World War. He came over with them, was born actually in a displaced persons camp in Germany after the war. So, we grew up as a kind of typical first generation. My dad was a lawyer by training. And I think typical of a lot of the families of that generation where people came over, they became doctors, they became lawyers, they became accountants, they had professions that had jobs and would pay bills. And that's how my dad really started out life. And real estate became started out as a side project to try and make some extra money that then developed into a real business. And so, when I grew up, my dad was just working all the time. So I wouldn't say that there was some grand perspective of real estate. There was no big office towers being built. My dad, from my perspective, for most of my life, was a lawyer who worked a lot, was great at coming back and spending time on weekends. And I would be one of those kids, so I'm told, who would get, dragged around and go to buildings when he was going to see apartments they were building or managing. But I don't have a huge recollection of that. Later in life, as I got into my teens and the business in Canada grew into the hospitality space, I have some more memories of that. And he was certainly always great about bringing me along for meetings and having meetings in front of me, and I would just have a pad of paper and there was lots of jargon, and he would just say, anything you don't understand, write it down, and afterwards ask me questions and I'll fill in the blanks for you. And I did a lot of that. So it was pretty organic. And so when I ultimately got in the real estate business here when I was 25 or 26 years old, which we can talk about, it wasn't part of my, like a lot of people, wasn't part of my thought process on a plan. He came and said, I said, I know nothing about real estate. He said, no, you know more than you think. It's in there somewhere. So I feel like I did grow up around it, but it wasn't in a particularly, I wasn't one of those, we weren't in the building business. It wasn't like I started out on construction sites and worked my way up doing different things. I went and did my own things, went to school and went to university. And the business in Canada is a partnership between my father and a partner who we met. The two of them got together as partners in their early 20s. So it's an interesting setup because it's two families that aren't related. So it's not a family business per se. And there's, I think, a lot of nice aspects to how that works. And so from that perspective, I never really thought of it as the family business. I thought of my dad and Wayne having a business together, but I never really had any sense of this is something that, my grandfather was in or something like that was multi-generational.
As a kid growing up, what kind of kid were you?
My mom would tell you I was probably pretty lazy. I don't think I was, there was no signs of exceptionalism. I think I was pretty decent. I was pretty above average at lots of things. I was a decent athlete. I'd be on the school sports teams. I would do pretty well at school. So I was lucky. I think a lot of things came reasonably easily, and I wasn't particularly ambitious about any of them. I went to a great school that I think I wrote an exam to get into, and loved playing baseball. In Canada and Ontario, there's no mountains, but there's some really small ski hills outside the city. And I would ski on those and learn to race around on ice. And those days, very tall skis for a very short person. So I did all those things, but actually, like I say, I don't think I was ever, you hear about kids these days who start businesses coding something in their basement, and by the time they're 17 years old, they've sold it to Google. That was definitely not that kid.
You left Toronto and you moved to the UK.
Yeah.
Why did you do that?
Well, a couple reasons. I mean, there's a little bit of a sliding doors moment, and then just, I guess, general life experience. But I went to high school in Toronto. Did my undergrad in Ontario, and I was planning on going. I was good at Grand Master plans. So my Grand Master plan was, I was going to go work at an investment bank in Toronto. I'd been a summer student there through university. Had a job offer there, was going to go there. And then the plan was go to the States, do an MBA, and then, I don't know, do whatever comes after that. And in the year of my final year, I went for what was meant to be my job interview, but the whole senior management team at the bank had been fired and replaced. And so when I went in for the interview, there was a whole group of people who I didn't know. And it was a pretty entrepreneurial merchant banking, investment bank. I remember very clearly because all of the walls were glass. It was kind of part of their style. So I sat in a meeting room and I waited for this person to come in and interview me. And he never came. I sat in a room for like an hour and a half. Those days was before mobile phones or anything. There was a magazine and that was it. So the time went by slowly. And I ended up, eventually I had to leave and go take my train back to university. And they never really followed up. And when I got back to university that night, I went round to a friend's house to commiserate, have a pizza and beer. And on the guy's table was a prospectus for the London School of Economics. So I just started flipping through. And I thought, well, if I'm not going to have this job, I might need something else to do. So I filled in the forms, got some reference letters from some teachers. As I said, I was always a pretty decent student. And within probably a month or two of that, I had been accepted to London School of Economics, and I thought it was a good opportunity to take a break, leave home, in my mind, make myself a bit homesick. Life had been comfortable, and part of me was the idea that I should try and make things less comfortable. So I thought that was a way of at least, when I came here, I didn't know a single soul. I think I persuaded one of my friends from university to come over as well, but basically I didn't know anyone here. And so that was a whole different experience for me.
So you came and you did business? Is that? 'Cause
Yeah,
you just wanted
I
kind
studied
of like
finance, economics.
broad schooling, kind of keep your options open.
Yeah, it was London School of Economics was, I studied finance and economics there and learned all about efficient market theories. Probably took you more in the direction of what would have been hedge funds or things like that. But that's what I studied there for that. It was a 10-month program.
You left LSE and then you set up your own business straight off the bat, if I'm not mistaken.
Well, the first thing I did was I got into the structured financing business for a short period of time out of LSE. I needed a job. My dad told me when school was done, so was sponsorship.
You're off the payroll.
I was off the payroll, which came as news to me fairly late in the day. So I managed to find a job working for someone who was doing structured financing and in the media sector. And I was doing that for 8 or 9 months. I really didn't know much of what I was doing, but I guess I was young and out of LSE, and he thought I'd figure some stuff out.
And what is structured financing in media?
Well, in those days, there were a lot of tax incentives to film movies in the UK. The UK wanted to build its film industry. It wanted to be more competitive with the US. And so it came up with incentives, labor tax credits, film tax credits for hiring UK labor, filming in UK studios. And there were financial groups that put together investors to invest in that, where you got a tax benefit for investing in films that may or may not, probably not make money. And the government was getting income into the system and jobs and so on by doing it.
Yeah.
Later down the road, I think those kind of structures got abused and taken to an extreme. But in the earlier days, I think they probably played a decent role in helping to develop what has now become, one of the preeminent locations for film shoots and studios around the world. So I was doing that, and one of my classmates from LSE had a flatmate who was at the time, this is 1998, 99, at the very beginning of the internet age, started a startup in network software and was kind of, in Time's top 50 people to watch, raised venture capital, was 24 years old, growing an incredible business, and was actually about to leave the business, kind of go from being a founder. They hired a professional CEO. The business was going to go public. And on paper, he was worth millions and millions of dollars and wanted to set up an investment firm. And we had spent some time together, and he said to me, look, why don't you come help me set up this investment vehicle? We'll do startup investing and angel investments. And the idea was we'll take investment only from founders or CEOs of other companies. So you had this really, really deep bench strength. They would help you find deals. They would help sponsor deals. They would co-invest in deals. And we were the investment partnership. And so there were three of us. We set up this investment fund called iGabriel. We raised 10, 12 million euros at the time to invest in seed businesses, mostly in the UK, mostly in software type strategies, most of which I knew nothing about. So I understood from some of the work I had done. I mean, bear in mind, I was 21 years old. My partner understood technology, and I was more business and common sense. And actually what you learn when the more you're in venture is you're really trying to assess the people and the market size and their ability to execute. Took a long time to kind of work that out, but that was the first business that we set up. And we did that for 2 or 3 years, invested through and into what was then the tech crash in 99, 2000. And incredibly, the days we were in the EU, the European Investment Bank really wanted to foster entrepreneurship. It wasn't really part of the culture here or in Europe. And so they wanted to give us more money to go do a second fund.
Even though you'd invested?
We had invested in 5 or 6 companies. 3 or 4 of them were going well. One of them had gone bust. A couple of them were still okay.
Yeah.
And they said, look, we think we need just to keep at this. Would you like to keep going? And I sort of took it as a moment in my life, again, you think about sliding doors, where I was then 24 and I thought, it's going to take 10 years to figure out if any of these companies are successful. And it's entirely plausible that none of them work. We'd been through the tech wreck. You could see at that point in time, how are you going to invest? What was it going to look like? Was it all going to go back to the US? And I just thought, I'm going to be 34, 35 years old before I know if I'm in a job that's going to be able to put a roof over my head and food on the table. And I'm not sure I want to sign up for that. So I decided that I didn't want to go do and raise that new fund. I told my partners, we ended up merging that investment vehicle with another group. And I took a step out and decided to take a little bit of time to think about what was next. And, at the time I felt pretty good about it. I was young. I had met dozens, hundreds of people in that space. I knew the venture capital community pretty well because of our investors. We had some amazing people who were our investors. A guy who sadly passed away a couple of years ago called Lord Miners was one of our original investors. Brent Hoberman from lastminute.com, which at the time was the poster child for the UK, was one of our investors. Still a very good friend today. A lot of some really great people. And I thought, I'll find something else to do. I think it'll have some better visibility. And the other thing was, I learned that I really like doing things and I wanted my opinions to matter. And when you're a passive minority investor in things, ultimately you're a stock picker and you're making suggestions, but you really have no real say. And so the combination of those two things, I just didn't think was for me. And so I decided to take some time out, start talking to some of the relationships I had from those days. And around that time, I was turning 25, and it just so happened my dad and my mom were coming over to celebrate my 25th birthday. And we were going for a walk around. I think we were walking at Mayfair somewhere. And my dad said, well, what are you going to do? And I said, I don't know. Figure it out. I had an office, had a great office and people, to discuss with. And he said, well, why don't we look at setting up a little real estate business here? I think it's an interesting time. I think there's some interesting opportunities. And I said, well, I don't know anything about real estate. That's when he said to me, no, you know more than you think. It's not that hard. And so we came up with a deal. I said, okay, fine. Why don't we do this? I'll keep my office. You pay me the salary I was getting when I was running the fund. We'll give it a year. And my only request is you got to come over here like once a month because I can't do this by myself. I don't know what I'm doing anyway. And even when I do have meetings, I look about 12 years old. No one's going to take me seriously. I need somebody to walk in and look halfway serious about what we're doing. So that was it. Him and his partner agreed to put up the overheads for the business. We decided that if I found deals, he seemed confident that we'd find a way of investing them. I asked him where the money come from. It was slightly unclear to me. And that's what I started doing. And so I literally, this is 2002. I started making phone calls, seeing people I knew, having meetings with them, writing them thank you notes, following up, and thinking about what I might look at, knowing that and really what I did was I kind of approached what I was going to do by what I wasn't going to do. So I looked around the market and said, what does it seem like other people do really well that are really well established and knowledgeable and credible? And I don't want to compete in that space.
Because I'm just not going to be able, I just don't have an edge or an angle.
Yeah, I have no edge. I have no angle. I'm not sure how I'm going to capitalize anything anyway, but if they have lots of money and they know what they're doing, that's probably a bad place for me to start. So if you looked around at that time, the REITs here were kind of where life was at. So British Land, Land Securities, in the the retail world, you had Liberty, and you had a whole bunch of very large public companies. What became Into, and so I just thought, I'm not doing retail, I'm not doing office buildings, I'm not developing because I don't know anything about that. What are some areas that I can lean on, and also what are areas that maybe from what my dad and Wayne had done in Canada I could lean on, both from a credibility point of view and also ultimately. There were people in the office there you could lean on, ask questions, get some help. The main business in Canada was the rental housing business. And the truth is that really didn't exist here. So there was no, what is today the BTR sector, which just wasn't a sector. You had house builders who built construction for sale. And I wasn't going to do that. I wasn't going to buy land and figure out planning and figure out construction. So that was out. And so I started looking at alternative things. I started looking at the hotel sector. I started looking a little bit at the student sectors. And then the first thing I came across, really, again, by fluke, I saw an advertisement in one of the industry magazines for a portfolio of what were called doctor's surgeries from some partners who wanted to sell a portfolio they had built. Doctor surgery, to me, when I think about surgery, I think about someone cutting you open and stitching you back up. Turns out these aren't really that. They're doctor's offices, specialized doctor's offices. And it was a really interesting type of asset class because at the time you had very long leases, 30, 35-year leases. They were fully repairing, insuring. They were highly financeable. They were actually specialist lenders in the space. And it was sort of... If you did, this was I think it was a 20 million pound portfolio. So it was too big for a small person and it was too little for the bigger funds. And so I thought that was interesting. So I really just started chasing it up, learning about it, learning about the NHS and the Red Book and how it all worked and what the covenants was, and decided that I thought it was an interesting arbitrage between where government offices traded and what people thought doctors' covenants were, because actually the doctors' rents were reimbursed by the Red Book. There was a public company at the time called PHP, which was out there. So there was some third-party research and validation you could do. And ultimately, within 6 months of setting up the office, we ended up buying that portfolio, and that kind of put me into the real estate business.
So how did you finance that first deal? Your dad was like, yeah, we'll find a way. How did you actually capitalize it? And did you have a business plan in terms of once you bought it, this is how we're going to drive value? Or is it just a case of I'm going to buy it and then I'm going to clip the income and then work out what's
it was
next?
like a very, again, so when I got into the business, I said, I don't understand real estate. My dad said, well, there's only one rule. The rule is don't go broke. That's the number one rule, whatever you do. So the way that we looked at it was you had this fairly robust long-term income. Rents were going to go up every 3 years, and that was highly financeable. So the short answer is, in those days, we borrowed a lot. I mean, we borrowed 90+% of the purchase price. And between my dad and Wayne, they put up the balance of the equity. And that was how we got into business. So they funded the equity on the first deal. And then once I started looking at the sector, I thought that we could go buy more. And at that point, I turned around and started raising capital, mostly from high net worth kind of family office type investors, to grow that portfolio. And I spent the next 2 years in a car driving all over the country looking at surgeries. I mean, we own surgeries up in Southport, Blackpool, Crewe, down all the way into Kent and Deal, everywhere in the middle, and a lot in and around London. But I saw more of the country than most people with my accent have seen.
And so it was just a case of build a portfolio of size, of scale.
Yeah, we were buying cash flow. We liked the cash flow. There was a gap between the rate we were borrowing and the yield on the assets. And we thought that was a stable, really interesting space. And we thought rents were going to grow because at the time, Tony Blair was investing a lot of money into the NHS. So it was driving rental growth. And we thought that if the market one day woke up and realized that we thought that the credit was mispriced, then there was upside in that. If it didn't, it was safe anyway. And if it did, that was kind of an arbitrage that would get realized by the market. And ultimately, 2 or 3 years later, that's exactly what happened. The market woke up, more capital got raised, cap rates compressed. It meant it was hard for us to buy anymore. And then we ended up with this portfolio of 20 or 25 surgeries, and we couldn't buy anymore. We held them. We ended up holding them for another 15, 16 years. We ultimately sold them to a publicly listed REIT, but we held them for a pretty long time.
At what stage did you think, the real estate game is something that I do want to focus on?
I never really thought of it that way. I've always focused on financial security and a framework for, like I say, food on the table, roof over my head. I come from a background where my grandparents were Holocaust survivors. My father came from that mentality, was born out of that mentality, and it got drilled into me, even though I wasn't firsthand. And so when I look at work, it was always a means to an end. And the end was very much about insulating myself from things that can happen to you. And so what I saw in real estate was, if you understood how to do it and put things together and could see where value was and protect your downside, you could do that slowly and consistently. Then it seemed like a good road to do it. It was total opposite of the technology world.
That's what I mean. You kind of was move out of that space.
Fast growth, high reward,
speculative,
totally binary results. And so this was much more up my street in terms of my general risk appetite and tolerance for risk.
You started building that first portfolio. How did you move, or what was the strategy in terms of kind of growth of the Realstar platform over here in the UK? What other sectors did you go into?
It was funny. Stage? People used to always ask me that. We'd have meetings and people would say, so exactly what you just said. And I just said, we're strategy-less. I said, I have no idea. I mean, genuinely no idea. I mean, and part of that is because the business we're in is one that part of the strategy is that you have to wait for opportunities present themselves to you, that the market will tell you where those opportunities are. And sometimes the market says there's nothing for you to do. And sometimes the market gives you lots to do. Obviously hindsight's 2020 and you'll know looking back. But I think part of the problem is to say, I want to go do all between now and the next 5 years. Here's my plan. Well, that's great. But what are interest rates going to be? What's the government going to look like? What are regulations going to look like? How can you have a plan that says that? And so I've always been slightly more pragmatic about it and said, I'm going to stick to things that I think we can be differentiated, where I think that there's downside protection and growth for some reason, whether that's supply led or policy led or otherwise. And And then that will drive us to those areas, and that's what we'll focus on. So you could call it opportunistic. I always just said it was strategy less. It was just, we'll see. And quite frankly, we're having our, I can't remember, 22nd or 23rd anniversary this next year. And that's been the plan all along. There's been no grand master plan. It's really put one foot in front of the other. And I always say, in the world of the tortoise and the hare, we're the hare. We're the tortoise. We're sitting in a building today where there's a media company downstairs called Tortoise. We're just one step at a time. Try and make sure you're going to make mistakes. Make sure those are flesh wounds and not fatal. Because you couldn't be an entrepreneur, you can't be an investor with total certainty. Otherwise, all you do is buy government bonds all day long. So I think that's always been the approach. And if you look at their risk appetite, some of the things look pretty risky, but the way that we approached it, I think we knew what the risk was, we boxed it off, and therefore you can live with that. And I think the important thing is upfront knowing what your tolerance is and knowing if everything went wrong, you're still fine if it did. If you go to the second thing we did from surgeries, it was the other end of the spectrum. We started looking at the hotel space. The business in Canada had previously owned a hotel company. I thought that was an interesting space here because what had happened in the US in the early 90s recession really hadn't played out in the UK yet. In the UK, you had these big, what they called leisure companies that owned pubs, beer, casinos, and hotels, some confluence of those, Whitbread, Bass, Ladbrokes, others. And they were all being broken up in some way, shape, or form through shareholder activism or some other method. And so I really thought there would be an opportunity to buy hotel real estate and mirror the model that you had seen in the US was what they used to call bricks and brains, where you had property owners and then you had management companies. And you didn't really have that in Europe yet. Even Hilton as a company was separated. The US company was different than the international company just through quirk of history. So we started looking around at some publicly listed companies. We actually tried to buy a couple of them, found some private equity partners in those days who were always looking for operating partners to kind of do the day-to-day work of and running these businesses. And so in 2004, we came across what is now IHG PLC was looking to shed its balance sheet owned real estate. They had two portfolios. They had a bunch of intercontinental hotels and they had some Holiday Inns. I tried to buy the intercontinentals. They said they wanted to sell the Holiday Inns. So we took a look at that and ultimately we ended up buying from them essentially all of their UK owned Holiday Inn estate, plus some Crowne Plazas, a couple expressed by Holiday Inns, in a very complicated transaction where we agreed a management contract with them, which typically was not the case in the UK at the time. Leases were more of what investors looked for. So we were taking all the operating risk, the trading risk in the asset. And in the end, that was 2004, we closed the transaction in 2005. It was a joint venture between ourselves, what was at the time Lehman Brothers real estate private equity business, and GIC Real Estate, which is the government of Singapore's sovereign wealth fund. And we bought 13,000 hotel rooms, 73 hotels, all in the UK. And we create a platform to be the asset manager for that portfolio, for that joint venture. And so, thinking about extremes, we went from 2.5 years earlier, nothing, doctor surgeries. And then when we closed the Holiday Inn transaction, I don't know, we were probably, if not the biggest, one of the largest hotel owners in the country.
And you hadn't hit 30 years old yet?
Yeah, I think I was 27. Yeah. So it was kind of a crazy time, a crazy run from 2002 to 2004, 2005. And then that just kept going. I mean, it kept going in terms of the market kept kicking on. And every headline that ultimately played out, we sort of, were a bit player in. We had commercial mortgage-backed securities, which obviously was part of the whole debt crisis in the US. We were partners with Lehman Brothers. That had its own side story. The hotel space on its own was, as you imagine, once you hit the wall in 2009, 2010 in a tailspin. So it was the MBA of MBAs, if you put it that way. I mean, it had everything. We had debt, we had hedge funds go buy into the capital structures, we had to renegotiate bonds, we had the operating performance of the real estate. We ultimately ended up agreeing with Holiday Inn to collapse the management contract and convert it into a franchise. So we ultimately managed ourselves. So there was a lot going on.
How did you do?
Portfolio.
How did you do that? Having not not had institutional training at another private equity shop or management business, you're kind of like flying the plane. You're building the plane while flying it, and of course you'd have had a team at this stage, right, and had some good advisors to help you. But how did you get your head around the different structures, parts, and ability to do the type of deal that involves 13,000 beds?
Well, I'd say a few things. Number one is I didn't do any. I mean, there was a group of people starting with, what I said about my dad coming here once a month. I definitely upped his game a lot once I had found this deal and called him and I said, look, I think we're going to do this hotel deal for £1 billion. I think you really do need to come over here and spend some serious time. To his credit, he did. So that was a big part of it. Our partners in Lehman's and GIC were at the time very experienced, savvy investors in hotels and generally speaking in real estate. And then we hired a team, which was one of the benefits of what we did is we put the people in place after we knew exactly what we were buying. So we created a custom-made group of people specifically who had expertise in UK mid-market hotels, and so we created our own little dream team of people to accomplish what we wanted to.
And you had the fee stream as well to justify it, right?
Yeah. So at the time, then all of those things came together at the same time. You weren't speculating to accumulate. You knew what you were going to have, and you built it to suit. So. I wouldn't take any credit for those things. I learned as I went and did what people did, but and I'm sure over the 10 or 11 years that we owned the portfolio, I knew more at the end than I knew at the beginning. That's for sure. But everybody, played a part in various aspects of that story over time.
Quick one from me. If you haven't already subscribed or followed this show on the podcast or app where you listen or watch, please do. It takes 10 seconds and helps tremendously. I've got really big plans for the People, Property, Place podcast, and that one small action really, really helps grow the show and the presence and enables us to keep doing what we're doing. So if you haven't already, please follow or like on the platform you watch or listen to. Thanks so much. Did you get badly burnt in 2008, 2009 with the GFC?
Well, I think everybody got badly burnt. It depends on how you think about that and talk about it. I mean, we had a few things all happen. Holiday Inn decided to rebrand just before the GFC. So there was a whole bunch of capital expenditure from the cash flows that were reserved and needed to do that exactly at the minute in time. They didn't need to or want to do that. Lehman's went broke, which actually in our case didn't affect us so terribly. We weren't part of the balance sheet estate. So it was more noise than it was true impact. And then cash flow fell off a cliff. So you had to manage cash flow. The blessing that we had on the other side was we had an interest rate profile which wasn't fixed at the time that the GFC happened. We had swaps that were burning off. So we benefited from the reduced interest costs of the cuts that were made at the time, and that was a lifesaver. And then we did a lot of heavy lifting to reorganize how the business was run, like all businesses, to save cost. And between all those things, going back to the original lesson of don't go broke, we went into survival mode. And unlike a lot of the similar transactions that were done in that area, we survived. I mean, nobody thrived, but we certainly managed to get through it. We went back to all of our lenders. We were really, really transparent with them. It was a strong sponsorship group. We had delivered on what we had said in the time up to that. I sat in meetings where you'd enter a boardroom and there were like 50 people from banks. I couldn't tell you, who was from what bank. It was just a bunch of faces. And we had to talk about, right, how are we going to extend the loan? How are we each going to take a share of pain? We'll put some money, we had sold some assets. We took some of the proceeds from those assets we had sold, put it back in, extended the loan, gave us ourselves some more runway. And by 2013, it was just the beginnings of some green shoots, and we managed to refinance that bond in 2013. It was probably the first big hotel refinancing that took place in 13. And then as we left 13 into 14, we decided, right, now is a time that we think there's some liquidity in the market. Let's go exit, which was always the business plan. It was just 5 years late. And so we started selling assets in 14 and ultimately sold. We had to break it. It was too big for the market at that time. So we broke it into 3 different groups, and we sold those 3 portfolios between 2014 and 2015, and we fully exited at the end of 15. Ironically, again, just talking about cycles, at the time we sold, thinking about it now, the word Brexit wasn't even a word. So we missed that cycle of what it was going to mean for the UK and liquidity and so on, fortunately.
Luck, judgment, timing.
Yeah, just luck.
All of those things.
Who could have predicted that? I mean, nobody in 14 or 15. The time we were selling, people were worried about the Chinese stock market as a topic. So, and UK, US, back in that same place, trade wars. So, no, that part was fortuitous. So it was a kind of confluence, a combination of everything.
What opportunity presented itself next? And how did you kind of scale the business from there?
So one of the things that I learned in the early days of our hotel portfolio is being an operating partner is great, but as you know more and have opinions, they're just recommendations. They're not actionable necessarily. And so around 2006-07, I decided that we wanted to have some more control over our destiny. And so we started raising some more traditional private equity funds where we would have more of a club fund, a group of investors, like-minded investors, but we'd be the general partner and have discretion over what we were buying and when we were selling. And so we raised we started raising the fund in 2006, 2007. And we actually, speaking of fortuitous, we actually had a close on our fund the day before Lehman Brothers declared bankruptcy.
Wow.
So I remember because I was invited, we did a press release saying we'd raise this fund and here's what we were looking at.
How much did you raise?
We raised about 200 million. It was going to be pan-European, 200 million euros. So we thought we had, call it 600 million euros of firepower, which...
That's a big ticket back then.
Yeah.
Right? It sounds small in today's change, but back then that's huge.
Well, and in going into the GFC, you would have thought that was going to give you a ton of firepower to go do things. And that the date we closed and signed, that's in the world of pure luck. I mean, had 2 days passed, who knows what would have happened. So I remember I actually went on the Today program, was interviewed on the Today program the morning after we closed because they just couldn't believe that someone had managed to raise money. And obviously it had happened before Lehman's, but it all kind of aligned. And so we had this pool of capital, and that we still owned the hotels at that time. And we started looking at where can we go find some more bespoke opportunities. Could be hotel, could be resi, all those kind of alternative asset classes that I mentioned. And so that's what we looked at. And the reality is it took me a year before we did our first deal. It was a tough year because I wanted to go prove to the investors that we could do what we said we did. At the same time, there was so much, everybody was stuck. Banks were stuck. Investors were stuck. There was zero transaction volume. Banks didn't even know what they owned for the most part. And so we just sat there and really held our nose and were really disciplined. There were other things we could have done that didn't look like our investment mandate, but I decided that we weren't going to just pivot 5 minutes after we closed into something else, even if I thought it looked great. And ultimately, the fund went well. We bought the kinds of things that we said we would, starting from 2010 onwards. And we were rewarded because our LPs, I think, really respected the fact that we had that discipline. And so when we were done that fund, one of our LPs in particular came back to me, and I used to write these really long letters every quarter about what we didn't do and why. It was painful. And when we were done coming to the end of that fund, he came to me and he said, look, the deals you've done are fine and we're really satisfied, but actually, if you want, we'd like to create a bigger vehicle with you, do more with you, because you said what you were going to do and then you actually stuck to it. And I can tell you we had lots of managers who didn't do that, and we respect that, and that's the kind of thing we're looking for. So in the end, I didn't know it at the time. It really served us well and has helped to cultivate a really long-term relationship with investors. And going back to, I took the decision around that time that I didn't want to go around and have. I know you had my friend Keith Breslauer on here a little while ago. Keith will meet, and he'll tell you about the endless numbers of investors he has and meets and talks about. And I went the other way and said, I'm going to try and cultivate a small group of investors who I can keep going back to on the basis that for the kinds of things we look to do in the geographies that we're in, probably there's more capital out there than there are deals that I can find that we want to do. And so if I can find a small enough, high enough capitalized group of investors who want to keep coming back and doing things with us, that'll keep me off airplanes, but keep us doing the things that I wanted to do. And one of my partners in life once said to me, if you're in the real estate private equity business, the mistake people make is they think they're just in the investing business, but actually they're 50% in the fundraising business and they're 50% in the investing business. And I always remember that. And I think I sort of took the decision that I didn't want to be in the fundraising business. I really enjoy identifying opportunities, finding them, executing the transactions, and then delivering on a business plan. And I didn't want to spend half my life fundraising. And so I pivoted our business to suit that.
Is there not risk in having 3 or 4 LPs compared to hundreds in terms of, their mandate changes or something outside of your control changes? And
yeah, there's risk in everything. I mean, the way I think about it is I've been at it for 20 years now, and I genuinely can't think of a deal that I really wanted to do where we couldn't do it because the capital wasn't there. The hard part is finding for us, I feel like the hard part is finding the opportunity, not finding the capital. And when that stops being the case, then you'll be totally right.
You moved into the UK BTR market, if I'm not mistaken.
Yeah. I mean, it happened by evolution. So in the first fund, when the world went broke, one of the opportunity sets we saw was buying built for sale residential developments, a lot from Irish developers, the likes of Nama, the Irish Bad Bank, and others, where we were buying these buildings on block. We thought what we could do is buy them at pretty significant discounts to what we thought their sales value in a normal functioning market would be.
At an individual kind of flat or door basis.
Right. And then in the meantime, we would rent them out, have some cash flow, and then when the market returned, sell the units off individually. So it's kind of a wholesale to retail approach. And we did that 3 or 4 times successfully. And then we kind of migrated as we moved into future funds that had longer duration. So as I was saying, one of our investors, we said, look, let's try and create more of an evergreen approach to owning assets for longer. Well, once we could own it for longer, then we didn't have to break the assets up and sell them, and then we could hold them for income. And so we started looking at opportunities to build and hold. And that sort of is how we ended up migrating into what today people would call the build to rent space. At the time, it was more just the next step in the evolution of, well, if we're going to hold these things, we may as well look at structures where maybe we can build new and build them to how we'd want them to be. And also, if you extend that further, we may as well manage them ourselves, because we think, given our background in Canada, we have a good way of doing it. If we were just going to own it for 3 or 4 years and sell it, it didn't really make a whole lot of sense to set up a management infrastructure here just to manage for that period of time. To my point earlier of, I don't know when the next deal is going to come around. But if we are going to do this for a long period of time, then it makes sense to be in control and do it for ourselves. And so starting in 2013, 14, we started on the path of either finding existing buildings that were fairly few and far between that were entire blocks that we could hold, but more in the build space. And that sort of is what took us down the path of being in the build to rent space.
And I guess creating a vertically integrated platform over here in the UK to do everything from the capital raising through to the management and rent collection and everything in between in terms of building the building and driving value from other buildings that you haven't necessarily built.
Yeah, and I always say, like, if you've been in the hotel business, in the real estate space, and I can't speak to logistics or retail, but generally speaking, I think everything else is doable from there. The hotel business has so many moving parts. You're renting a room every night. You have a mix of business. You have different types of customers. You have HR, you have technology, you have CapEx, you have marketing. There's so many moving parts. So when you go down the food chain to other asset classes, it's less difficult to get your head around. So I thought running an apartment building was, obviously we had a lot of experience in doing it in Canada and we could lean on that. So then we sort of extended that thought process where as we then moved from building buildings and managing them ourselves on a kind of no-name basis, and I had visibility that we could hold on to buildings and build them how we wanted with the right capital partners, then the idea of creating a brand sort of came to my mind as to why don't we marry all of our skills and knowledge from hotels and hotel brands into the residential space, where now actually we're going to have a large enough growing group of assets to make that work. And so in 2015, 16, the idea for what ultimately became the Uncle brand sort of was hatched in my mind. And as I looked around the world, I thought, you have commodity products in lots of sectors. Hotels, ultimately it's a room. Car rental, they're all the same 5 companies. Airlines, they're 2 companies. But you have all these different companies and brands and loyalty and pricing premiums. Why is rental housing any different than that? If anything, it's 50% of someone's personal after-tax income. How they're treated, what their loyalty is, what that trust factor is, what the product looks like should matter more. So why don't we try and create what looks like a hotel brand in a long stay kind of apartment format? And that's sort of how we created the Uncle concept.
Back in 2010, 11, 12, 13, the kind of institutional residential space, there were very few players, right? I mean, it's all the rage today, but back then it was office, retail, and industrial, and maybe Granger. Yeah,
you had Granger, who ironically we shared an office. We were in the same office building as Granger for about 10 years. And Rupert Dickinson, who sadly is no longer with us, who was the CEO of Granger, became a very good friend. So I spent a lot of time with them just by happenstance.
And then it was like the buy-to-let landlords, right? Who'd kind of grown portfolios, but it wasn't necessarily institutionalized.
Yeah. And then you had estates, you had Dolphin Square, and you had some kind of one-off historic things that existed, but you didn't have any at-scale operators.
And so in terms of like actually building the brand, the platform, hiring and convincing people to kind of come on the journey, what was the hardest thing about that? Or were you able to point to Canada and say, look, the wind blows from west to east. This is kind of what we've done. This is what we've pioneered, and actually we want to take the model over here, and you get some kind of proof of concept.
Yeah, I think the hardest part about it, and it's the hardest part today, is there is no clear path to growth. So I was never worried about the demand or what we would deliver for the customer or how that would work. I thought we'd figure that out. You're always going to have roadblocks and stumbles, but I thought they were all pretty solvable. I think the challenge was more, if you think about Premier Inn as a hotel company, there's a path to growth here. They've managed to grow to hundreds of thousands of rooms. I would say that in the build to rent space, I've always said it's a deal, not a business. So if I look at all of our assets today, and we're probably knocking on the door of 5,000 or 6,000 units, every single one has a story that I could tell you about how and why we did that deal. It wasn't just, a funnel of opportunities that came in and then you pick your way through it and enough of them work and you just know you're going to get to an end result. If you were rolling out Starbucks or Pret a Manger. You have a criteria, you want to be on these locations, on these high streets, at these rents, and your business model works. That is not the way our business works. There's moments in time where there's a house builder who wants to sell a phase, or a developer who needs some capital, or there's just always some story. And so it makes it hard to grow at scale. So, if we sold all of what we had tomorrow and said, do it again, I wouldn't be back in this podcast for another 15 or 20 years.
It's so funny. It's almost going back to how your dad and Wayne started the business over in Canada, just in terms of like doing one and then the next, and just like iterating and seeing where the opportunity is and being opportunistic to kind of build it, rather than be, I don't think focus is the wrong word, but cookie cutter.
Yeah, Canada was slightly different because actually what the UK government hasn't done, which the Canadian government did at the time, and when they recognized they had a shortfall, they actually created a lot of financial incentives to build rental housing. So my dad and Wayne were going off the back of a bunch of government incentives to create rental housing that created, at the time in the 70s and 80s, really a mini boom in growth in rental housing that then disappeared because the incentives went away. But here we've never had that. So in their case, there was actually a bit of a roadmap for a window of time. And then they ended up being more of an aggregator of other people who had done the same thing. So they shifted from building buildings to buying buildings. Here, I just don't think we've seen that boom. I think it's still, we're 6,000 units. If you look at Canada, our business in Canada is 25, 30,000 units, and we'd be like a mid-sized player. The biggest, REITs are 60,000 units.
Starlight.
And yeah, I don't know what Starlight's got, but Cap REIT would be 60,000 units. And Canada's half the population of the UK. So if you think about it in simple terms, the UK is 60 million people. You should have people in the multi-rental space who all have 50, 60,000 apartments around the country. And today, we would be one of the larger operators, and we're nothing like that.
So fast forward to today, can you just give a bit of an overview of the portfolio? I think you said 6,000 beds. It's about 3 billion under management.
So today, Uncle is a brand we created that suits a certain type of building and location. So we probably have 3,500 units in the Uncle portfolio, most of which are in London. London is, sort of zone 2-ish location. I mean, we have one in Elephant and Castle. We're just finishing one in Acton next week. We opened Deptford. We've got a big portfolio of assets in Wembley, Stockwell, New Cross, kind of around those types of locations in the city. So that's, and then it also is, we're building nearly 1,000 units up in Leeds. We delivered 460 of them this year. There's another 480 to come next year, and an asset we have in Manchester. And we'll probably do one or two other provincial cities, but still keep the bulk of the value London-centric. And then we have other assets that are not branded Uncle that we still manage for various reasons. So, we have an asset in Hammersmith and in Brixton and in Battersea and other locations that aren't Uncle buildings. That are inside the portfolio. And we still have some student housing as well. So we have, the student housing building in Hammersmith and one in Old Street and City Road. So there's a mix of assets. It's not just limited to Uncle as a brand. We've owned hotels since we own the Holiday Inn portfolio. We developed my favorite hotel I was ever involved in, called the Bankside Hotel, just behind Sea Container's house. We got to being ranked, I think, in the top 5 in TripAdvisor within the first year of opening, and was definitely a labor of love. We sold the asset a couple of years ago, but it was a brilliant, fantastic experience. So we'll still do hospitality-related things. We'll do student things. I'd say co-living fits inside the universe of BTR. It's kind of a sister or a cousin, if you like. So those are all things we'll do. And often I've looked a lot at self-storage over the years.
I was going to say, because you touched on at the start of the conversation, kind of looking at the bigger, more established players and thinking, actually, I don't have the balance sheet or know-how or relationships to be able to capitalize on that. Given the size and scale of the business that you have built, do you feel that you can maybe compete or move into other other sectors?
Yeah.
And you touched on self-storage. Are there others that you'd maybe move into that you could take like the operational know-how and the kind of the learnings from the hotel piece that you touched on earlier and apply that to a different sector?
Yeah, I mean, I've always, before people talked about the living sector, I talked about buildings with beds. But broadly speaking, I would say we tend to look at operating businesses with real estate on the balance sheet. So take self-storage, we kind of joke it's apartments for inanimate objects. I've looked at cemeteries before and thought those are just condos for dead people. So, there are other asset types that have the same dynamics of occupancy rate, property on the balance sheet. In Canada, we've been in the manufactured housing space. We've looked at that where we can. It's not really much of a sector here, though.
Maybe temperature driven, right? Over here, just...
I think planning is a big part of it here. Land availability with Greenbelt, things like that. So, and we've looked on the continent. We actually have a portfolio and a joint venture in Ireland. So that's the last couple of years. So we've spent some time in Dublin the last couple of years, and have a portfolio there of about 1,500 apartments in the city center. We've looked on the continent. We've looked in Scandinavia, more Northern European markets probably, and a little bit of parts of Spain. So we've looked at different opportunities, and I go back to my original comment about strategy less. If someone brings us something that looks like there's a reason for us to do it, I feel comfortable about the risk and how to manage it, there's no reason why we wouldn't. Might be a wind farm. I honestly, it could be anything.
Sounds really exciting in terms of like what the next evolution and the next journey that you'll go on in terms of the wider business. For someone who's setting up a business right now, and there seems to be a lot of people who've spun out of some of the bigger shops and are going to kind of try and raise capital or pitch strategy, what advice would you give them as they try and build and take advantage of the opportunities in the market at the moment?
I mean, if they're going out on their own and they've got some visibility of backing, my start point is they probably already have a pretty good idea of what they're doing, because the market is very discerning as to who it backs these days. The reality is the check size you need to get the cost of entry to get into the market is so significant these days. You can't with reasonably wealthy uncle and a couple million quid get into the real estate business anymore. It's just too expensive. Values are just too high. So the reality is it is an institutionalized generally space if you want to be a manager of real estate investments. And therefore, if you're getting into that space, the first thing someone's going to ask you is talk to me about your track record. Show me what you've done and get into some real detail. So if I was being honest, I'm not sure there's a lot I could tell them. They probably already know pretty well what they're doing. I do think the business has changed a lot over 20 years. If you look at who the players are, how capital has evolved, I think it's getting tougher and tougher for that middle-sized manager. Regulatory costs of just running the business are double or some massive increase on what it was. You could have had 3 people in a room with some admin help and farmed out your finance as a back office and run the business on not a ton of overhead. I think that's harder and harder to do. And institutions know that, and therefore getting that scale and backing. So raising 100 million or 200 million, which is a lot of money, doesn't get you very far. Just when you look at management fees and what it costs to run the business. So I think it's getting harder. You have at one end of the spectrum, the huge behemoth players out there. And then you've got a lot. What's also changed is the traditional limited partner investors, sovereigns, and so on have created their own direct investment strategies themselves with very capable people running those businesses, which wasn't, that wasn't the hire they were making in the past. In the past, they were making hires on people who knew how to pick managers. Now they're hiring people who were investors. And so I think that the landscape's changed a lot. So I do think it's become harder and harder.
We've got a new Labour government. They talk a lot about housing, ambitious targets. What's your take on it all?
Look, for a start, I think it's fantastic that a government is putting housing so high up the agenda. It's a hugely important topic, not just in the UK. People talk about the housing crisis in London. The reality is there's a housing crisis in every major city that you might think of, whether that's Toronto or Paris or New York. And so I think it's important. There's certainly, on the early days, seem to be doing a lot on trying to look at the planning process, which I think is really important. And that will help to start to unlock things. I think the next part of the puzzle is really going to be, if you have the planning itself, the economics of building today are very different than they were 5 years ago, largely driven by the reality of the interest rate environment. And so if you look at the combination of how high construction costs have gone, the interest rate environment, and expected returns about your alternative investment universe, I think what they're going to need to do to get large scale institutional capital into the market is a challenge that they haven't yet really come up with, I think, a program that I've seen that's going to mobilize capital. So if you look at us, for example, we haven't agreed to fund a new build to rent development in over 2 years since all that's changed.
Because it just doesn't stack.
And the math just hasn't stacked. Lately, I'm starting to see some things that may or may not be there, but it's very specific and very bespoke. But going back to my point, it is a deal at the thin end of the wedge, not a business by any stretch. And if they're going to get to a place where they start to ramp up towards this housing target, there will need to be programs in place that make it financially viable for large scale capital to jump in.
What would the quick wins be, or the recommendations from your side to unlock those?
Well, I think there's lots of, it's a matrix. So if it were me and you were, you almost need like the housing czar type person that's empowered to listen to capital and say, what do you need? And how are we going to make that work? If you look, for example, in Manchester, when you had Howard Bernstein as the mayor, he really got things done. He talked to business. He understood what they needed and listened to them, and he delivered for them. And Manchester has been a great growth story over the last decade. So I think you're going to need a plan, whether that's regulation, whether that's 106, whether that's viability, like different things are going to need to stack. Government subsidy and financing. There are lots of different ways you could skin a cat. I think the way that I always put it is, the government policies are really good at words and investors are all about numbers. And so far, I don't think those two things have met up. So I do think you're going to need formulas and math that stacks up. And once you have that, I think you can unleash floodgates of capital, because people really want this kind of social infrastructure, reliable income streams on the rental side. And on the housing side, we know all the benefits and why people want it, so socially and otherwise. So I think there's a world of opportunity. The UK's challenge also is going to be balance sheet. It's not as wealthy as America. It can't print dollars forever. And so finding sources of funds, as we saw in the last budget, is going to be a challenge. But if they're going to hit those targets, they're going to need to find new ways of being friendly to business to open those doors.
As we draw to a close, Ryan, a question I ask everyone who comes to the podcast is, if I give you £500 million worth of capital, who are the people, what property, and which place would you look to deploy that capital?
So is that a global question, or is that right? Okay. Look, one of the things I've loved about the multifamily business is, if you think about property generally, so it's an undersupplied sector in lots of places. Unlike office buildings, which I would tell you after 30 years, you're into either a monster refurbishment and even likely to tear it down and start over. The buildings never really depreciate in terms of tear down and start over. And technology hasn't really disrupted the space. So from a stability and safety and reliability point of view, I think the housing space is a great space to be in. Where you would do it, I think, is you want to be in geopolitically stable places, because the biggest risk to the space is more government intervention. If you look in Ireland, is the perfect case in point. The Irish government had put in a 2% forever rent cap. And financially, for any owner, that just will be financially unviable. And what you'll see is no supply, full stop. And buildings get to a bad place for reasons they just don't have money to fund. And so I think those geopolitical risks, where you have stability and clarity, are going to be the place to do that.
And in terms of kind of people, Is there anyone that you've worked on or worked with on your journey over the last 20 years that you would kind of bring in to help you deploy that capital?
It's a good question. I mean, we've been, it's funny, my job, I've never worked anywhere else and I've never been in the real estate business anywhere else. So my perspective is relatively limited and we've just kind of stayed in our own little lane and done our own little thing. So my exposure to that is probably less than some of your other guests. I probably have a less good opinion on that.
Have you had mentors throughout your career or outside of maybe Wayne and your dad?
I've had lots of mentors. My dad is definitely my best teacher. But I've been lucky enough to spend time with some incredible entrepreneurs, not just in the real estate business, the hospitality space, and the telecom space, and the tech space, and I learned something from every one of them.
And married to one as well.
And I'm married to a brilliant entrepreneur as well. Yeah, it does help.
You, Ryan, have had a fascinating background. Kind of key takeaway for me is just that kind of the downside, risk mitigation, almost kind of like credit type mentality, the way you look at things, but also just slowly kind of iterating, staying in your own lane and seeing where the next opportunity is going to present itself. So I'll be sitting watching to see what you and the team at Realstar over here in the UK go on to do. So thank you so much for joining me today.
Thanks for having me. Appreciate it.
Thanks for listening to this week's episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Give us a rating, like, or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests that we should have on the show or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit leadership and future leadership hires for real estate owners, funds, investors, and developers. So if you're looking to hire top talent for your business, head over to the website www.rockborn.com, where you'll be able to find a wealth of information, or feel free to drop me a message on LinkedIn. Have a great day wherever you are, and I look forward to catching you